All right, let's talk more about the markets. This morning, Citi downgrading its U.S. rating to neutral from overweight after a solid first half of the year. The bank upgrading Europe in the meantime to overweight. And joining us right now is Noah Blackstein. He is senior portfolio manager at Dynamic Funds. Noah, how do you feel about where equities might be best positioned at this point, given the huge run-up we've seen in the U.S. the first half of the year?
Well, I don't think, toward the end of last year, everyone was saying, get out of technology, get out of everything. And everyone's completely caught off guard on a year-to-date basis. So, I think taking a longer-term view, I think, is certainly important. I mean, if I'm sitting here today looking at Wednesday's CPI number, headline will be around 3%. June 2022, it was 9.1. So some of the key components of core, whether that's used cars or owner's equivalent rent or other things like that, also, have not shown weakness versus more real-time data, which have. So, we're at 1/3 the inflation we were about a year ago. And the economy thus far, I think the ADP number was kind of out of whack, but, we're sort of seeing a jobs number of a couple 100,000. And so, I'm for now always wary of Federal Reserve mistakes or trouble in credit. For now, I'm kind of in this a little bit more of a Goldilocks type of scenario, which I think bodes well for certainly equity returns and certainly those companies with secular growth opportunities.
Let's talk about earnings season because we really get into it later this week. There were a couple of notes out this morning. Goldman Sachs saying that, they think that companies will be able to beat lowered expectations. And so you could hear a lot of good things coming out of surprise upside coming out of earnings. On the other hand, you have Mike Wilson over at Morgan Stanley saying, look out, it's going to be bad. They're not going to make some of these numbers. Which camp do you fall in?
I fall into sort of listening to the companies that you kind of own and their kind of view. I would say that, there are certain areas that are going to be under tremendous amount of pressure in financial services, for example, which have been dealing with this inverted yield curve, just this expensive deposits and other things like that. There are other areas where things seem to be okay in the consumer space and the restaurant space. Certainly, we're seeing a reacceleration in cloud migration in the technology space, driven by a lot of what's going on with AI. So you really do need to kind of pick your spots, obviously, as you always do. The other thing I would say is that I'm really not hearing anything about supply chain or cost pressures like I heard about a year ago. And so, if it's an inline top line number with better margins, I think the market would react well to that.
What do you like, Noah, specifically?
Yeah, as a growth investor and secular growth, I think I've been doing this for a long period of time. I think I started when Windows NT and that thing Mosaic browser was coming out in the early 1990s, but I've never seen sort of everything sort of come together like it has around AI and whatever you want to lump in there, machine learning, big data, and everything like that. We didn't really know what the ROI on a desktop computer was. We didn't know what the return on investment of Amazon was in the 1990s. But we're seeing real tangible return on equity for AI-powered chatbots, for dramatic reductions in call center costs. We're seeing automation and factory automation in terms of efficiencies that companies are getting. JP Morgan talking about driving sales processes with AI and reducing fraud. And so of all the cycles I've seen in technology, I've never seen one with such a tangible ROI. And I think longer term, this is it's a very, very important place to be. I think it permeates throughout the overall economy, makes the bigger companies with a lot more data and a willingness to harvest that data and analyze that data significantly stronger with better margins and, in fact, accelerating sales over time. But this is the coming together of almost 20 years of technology build and spend in the cloud and big data, and the implications on the upside are significant. Obviously, I do listen to a lot of these debates on labor and labor costs, and just remember, economists treat technological change as exogenous. We don't know what happens; it just sort of happens. I do worry a little bit of all this hyper focus on labor costs and other things, because I don't know what the longer term AI impact is to labor. Some people have it low as 75 million jobs lost. Goldman has it as high as 300 million jobs lost. People will be offset in other ways. But that's the one area where I think this hyper-focus on labor might be missing a bigger picture.
I don't know if you saw 60 Minutes last night. They did a deep dive on Alphabet and what they're doing with AI, the battle that they're in with Microsoft to try and see who's going to win at this. Do you have a favorite when it comes to what's going on with AI? Somebody you think comes out on top, or is there room for lots of winners?
Well, I think AI is a data strategy, and I think, whether it's data lakes or databases and all that in the cloud, will continue to benefit. I think the big winner longer term are the Walmarts and the JP Morgans and the McDonald's and all those companies who are going to be better at advertising, the generative AI, are going to be more efficient in warehousing and reduction of fraud and other things like that. So I think the longer term winners are corporate America as a whole. In terms of the winners and losers, is it NVIDIA chips? Will AMD close the gap? That's the fun of being an active manager. We'll see how that certainly progresses over time. But the longer term theme is extremely powerful.